Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of corporate filings. Today we're looking at Verrica Pharmaceuticals, and it seems like they're about to do a little financial origami, folding their stock to make it look different. Let's see what that means. Alright, so Verrica Pharmaceuticals has filed an 8K report. This form is like a company's instant message to the public, sharing important stuff that happens outside of their regular financial updates. Think of it as a company shouting, hey, something big just happened. The date here tells us right away that this filing relates to events happening around July 22nd, 2025. This is our company, Verrica Pharmaceuticals. They're in the business of making medicines, likely focusing on specific areas where they have expertise. Here we see they are incorporated in Delaware. Many companies choose Delaware because its laws are generally considered business friendly and well established for corporate matters. Now, this is where things get interesting for investors. Verrica's common stock, the shares that people buy and sell, is traded on the Nasdaq Stock Market LLC. That's a major stock exchange, so it means the company is pretty significant. And their ticker symbol, the short code you'd use to find them on a stock trading app, is VRCA. Keep an eye on that. We also see here that Verrica is not choosing to be treated as an emerging growth company. This usually means they've been around and are perhaps a bit more established, or they want to avoid certain regulatory accommodations. This section title sounds a bit dry, but it's where the real action is for this filing. Material modification to rights of security holders basically means they're changing something significant about what owning their stock means for you. And here it is. Verrica is doing a reverse stock split. They're changing their shareholder documents to make every 10 shares of their existing stock become just one share. This is like taking a bunch of small pieces of paper and bundling them into one larger piece. It sounds complicated, but it's a common move. The important part to remember is that this doesn't change your stake in the company. If you owned 1% of the company before, you'll still own 1% after, just with fewer shares. The only exception is if you end up with a fraction of a share, which they'll likely handle by paying you cash. So starting from July 25th, their stock will trade with this new lower number of shares. This can make the stock price look higher. For example, if a stock was trading at $2 a share after a 1-for-10 reverse split, it would theoretically trade at $20 a share. It's a psychological and practical adjustment. To put that into numbers, they currently have about 92.5 million shares out there. After the split, this will drop dramatically to around 9.25 million shares. That's a massive reduction in the number of shares circulating. They've also included the actual legal document that makes this change happen as an exhibit. Think of it as the official paperwork for their financial makeover. This section confirms what documents are being filed along with the report. And here it is again, Exhibit 3.1, the legal document detailing the reverse stock split. Finally, we have the official sign-off. This shows that the company is formally acknowledging and filing this information. And the signature here belongs to John J. Kirby, who is their interim chief financial officer. This tells us he's the one responsible for overseeing the company's financial health and these sorts of filings. Now let's talk about why a company like Verrica would do a reverse stock split. Usually it's done for a few key reasons. The most common is to increase the stock price per share. This can be important for staying listed on major exchanges like the Nasdaq, which often have minimum bid price requirements. If a stock price gets too low, it might be delisted, meaning it can no longer be traded on that exchange, which would be a big problem for liquidity and investor confidence. Another reason is to make the stock appear more attractive or substantial to investors. A very low stock price can sometimes signal financial trouble, even if it's not the reality. By doing this reverse split, Verrica is essentially trying to present a more solid financial image and ensure they meet exchange requirements. Looking at this, Verrica is taking a proactive step to manage their stock's appearance and market standing. The fact that they're doing a 1-for-10 split shows they likely felt their stock price had fallen to a level that was becoming problematic. While it doesn't change the underlying value of the company, it's a signal that management is focused on maintaining their listing and potentially attracting a different type of investor who might be put off by a penny stock price. The main risk here is that if the company's performance doesn't improve, the stock price might continue to fall even after the split, making the increase purely cosmetic. However, it also gives them more room to grow before hitting those low price thresholds again. Alright, that's a quick decode of Verrica Pharmaceuticals' latest filing. What's your take on this reverse stock split strategy? Does it make you more or less confident in Verrica? Let us know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more. And don't forget to join our Discord community. The link is in the description. Thanks for tuning in to Corporate Decoder.